It ain't easy. No, it ain't. Wow, talk about social evolution. I can't believe that my intentional use of the formerly non-word ain't is actually acceptable to all of my grammar and spell checkers. Back in the day when I was schooled in grammar, using that non-word was likely to yield you a big fat F on your work, maybe even some good old-fashioned corporal punishment. Really, it's not easy to keep up with social evolution. Artificial intelligence is one of those evolutions. I hinted at it in yesterday's video. AI has begun to change hiring patterns, and the trend is only going to accelerate. Companies are starting to rely on AI to make their existing workers more efficient. That means fewer workers are needed to get the same job done. If you're a company trying to boost profits, well, you slow your rate of hiring and you roll out AI tools. If you're a company worried about rising costs from tariffs, well, you freeze hiring until you get relief or some clarity. How do you continue to grow revenues with the same number of employees? Well, the answer is simple: artificial intelligence. Got it? Now, could these factors be why yesterday's employment reckoning hit so hard? The BLS revised its job creation numbers and found that for the year ended in March, it overestimated job creation by 911,000 jobs. That is not a small rounding error. That is an entire city's worth of jobs that didn't actually exist. Never mind the technical details of why. I covered that stuff yesterday. Focus on the implication. The labor market is not as strong as we thought. That's a big deal. And a weak market and a weak labor market is ingredient number one in the recipe for an economic slowdown. You need a job to pay for stuff. If jobs are weakening, the economy is also weakening. Tomorrow, we get the latest inflation reading from the BLS. Expect a slight uptick in CPI. If that uptick shows up in core goods, we are entering the dreaded zone of stagflation, or at least more discussions around it. That's low growth and high inflation, a condition first named in the 1970s and made famous in the 1980s. Here's the thing about stagflation, though. The Fed can't fix it by simply tweaking Fed funds rates up or down by 25 basis points. It's almost an impossible condition to cure. In fact, the Fed's usual tools don't even work. The only way out is to stall the economy, which is just a polite way of saying recession. So, are hopes of a soft landing fading? Well, not necessarily. Not all the data points say we're headed for the rocks. Employment weakness can be countered by policy certainty on trade and more accommodative monetary policy. The administration can help with trade policy, and the Fed, well, they can help with monetary policy. The Fed has been reluctant to cut rates because it fears reigniting post-pandemic inflation. But here's the question. Does the data really support that fear? I saw a chart this morning on Bloomberg from the NFIB Small Business Optimism Survey. It showed two data points: job openings hard to fill and price changes. Both have been in a long-term downtrend. Recently, that decline actually accelerated. At first glance, it looks like small businesses are finally catching a break. But look a little closer. The implications here are far bigger. This takes us straight into the Phillips curve. You can't escape the Phillips curve. The Phillips curve shows us the relationship between unemployment and inflation. Low unemployment means higher inflation because companies compete for scarce workers by raising wages. High unemployment means lower inflation because desperate workers accept lower wages. This is Econ 101. The Fed loves to cite this relationship, and based on the data, the labor market is weakening. That's why job openings are easier to fill. And when jobs are easier to fill, wage pressure eases. When wage pressure eases, inflation pressure eases as well. See the chain? Lower inflation pressure. That clears the path for the Fed to prioritize the labor market. Don't like the Phillips curve? Fine. Look at the white line in the same survey. Price changes. Small business owners are asked whether they changed their selling price in the past 3 months. That line is clearly headed down. Fewer businesses are actually changing prices. Fewer plan to do so in the future as well. Despite tariffs, despite everything else, that is straight up lower inflation pressure. So where does that leave us? Well, if you're the Fed, your job is not easy. Clearly, your mandate is price stability and maximum employment. And sometimes those two conflict. But right now, this ain't one of those times. The data is giving us cover. So Get to work, Fed. And here's your truth bomb for today. A weakening labor market is cooling inflation pressure, giving the Fed room to cut rates if it has the courage. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.